Good afternoon, everyone, and thanks for being with us for today's webcast. My name is Allen Webb, and I'm part of the Portfolio Specialist team here at RiverNorth. For those on the call not familiar with us, RiverNorth is a boutique investment management firm located in Chicago. The firm was founded in 2000 and focuses on investing in closed-end funds and volatility. In fact, we're one of the largest institutional investors in the domestic closed-end fund market. RiverNorth is the advisor to 5 mutual funds and the general partner to 4 partnerships that invest in these 2 asset classes. Please contact me if you would like information on any of our fund offerings. The purpose of today's webcast is to first discuss the current state of the closed-end fund market and highlight some of the potential opportunities. In addition, we will discuss the strategy and performance of our flagship mutual fund, the RiverNorth Core Opportunity Fund. Today's agenda will consist of the following: an introduction and a few quick announcements from me, followed by comments from RiverNorth CIO Patrick Galley. Q&A will follow Patrick's remarks. Q&A will be electronic only, and you may submit a question at any time using the Ask a Question box in the bottom left corner of your webcast player. Before we get started with the main event, I need to read a few standard risk disclosures on slide 2. Please remember the fund's objectives, management fees, risk, charges, and expenses must be considered carefully before investing, and that the prospectus contains this and other important information about the fund. Mutual fund investing involves risk and principal loss as possible. And finally, past performance is no guarantee of future results. I would now like to make a few announcements on slide 3. The most significant announcement is that RiverNorth launched an institutional share class for the RiverNorth Core Opportunity Fund in August. The ticker for the new share class is RNCIX. The new iShare does not have a 12B1 fee and does have a $5 million minimum. This share class should be available at all of the major independent platforms, and if you have any trouble placing a trade, please let me know as soon as possible. Next, if you would like a copy of today's slides, please call or email me using the contact information currently on your screen. Third, a replay of this webcast will be posted at rivernorthfunds.com in about 2 to 4 weeks. And last, for those of you who are active in the social media world, you can follow RiverNorth on Twitter using the handle @RiverNorthCap. And with that, I will now turn over the webcast to RiverNorth CIO Patrick Galley. Good afternoon, Patrick.
Great. Thanks, Alan, and thank you, everyone, for joining on the call today. Before we dive into the fund, I always think it's a great idea to give an overview of the closed-end fund space, given that it's such a significant part of our investment strategy. So I apologize in advance for those that are on the call and have heard the story before and understand and appreciate the inefficiencies in the closed-end fund space. But for those that are new to it, I think it's very important to have a good understanding. So the closed-end funds, for those that are not familiar, they are registered investment companies, similar to a mutual fund and an ETF, an exchange-traded fund. The major difference, though, is that they issue a fixed number of shares and they go through an IPO process. And the way they do that is they essentially go through a 30-day roadshow. Typically, there's a fund sponsor or a manager behind it, or not typically, but always. So some of the fund sponsors could be a Naveen or PIMCO, or one of our partners, DoubleLine, for example, has a couple closed-end funds. BlackRock is a big issuer of closed-end funds. And they go through a 30-day roadshow for a new strategy, typically going to the major wirehouses. And for example, if they raise a fixed income closed-end fund strategy, and if they raise $1 billion, there are hefty commissions that come out of that $1 billion that's raised, and typically it's around 5%. So it's important to understand this IPO process, because that $50 million comes out of that $1 billion that's raised, and now you have a security that's only worth $950 million. So when it gets priced just like a regular stock and it goes public, day one, you now have a security trading at a 5% premium to its net asset value, or the liquidation value of the underlying assets. And from there, the only way you can buy or sell that security is through typically the NYSE. And most of us in the secondary market don't want to pay $1.05 for $1 worth of assets. So that's where really the inefficiencies start, and that's also where RiverNorth comes in the secondary market. Typically, the closed-end fund's market price, the price that you and I can buy it at in the secondary market, ends up trading at a discount to its net asset value. And RiverNorth's strategy is obviously being able to buy $1 for less than $1. So for example, if we buy a closed-end fund trading at a 10% discount simply, and that discount narrows to 8%, that's 2.2% of excess return above and beyond what the underlying assets did. So it doesn't matter if the underlying assets went up or down, but we've generated 2.2% of excess return on top of those underlying assets. That's our definition of alpha, or excess return in the marketplace. And it's important to know that the net asset value is calculated every single day. It's similar to a mutual fund. It's priced out at the end of the day by a third-party administrator. So we know exactly what the underlying assets are worth every day, and we'll get into it a little later, but we take it a step further and estimate that net asset value intraday and try to take advantage of intraday inefficiencies. So the net asset value serves as an anchor. It's not like knowing what the intrinsic value of Apple is or Google, et cetera. Closed-end funds, the net asset value is priced every single day. So if it's trading at a 10% discount, you really do know it's a 10% discount. There's no question about that discount. The closed-end fund space by asset class, but starting at a high level, about 60% of the space are fixed income or bond funds. There's $300 billion in the total closed-end fund space, so $174 billion are fixed income closed-end funds. About 40% are equity or hybrid closed-end funds. That's $125 billion, and there are approximately 600 funds in total size. The biggest asset class, though, or sub-asset class out of the fixed income are municipal bond closed-end funds. So about half of the fixed income space are municipal bond closed-end funds. Almost about $80 billion worth. And you can see the diversity here on this chart over all the asset classes. So what's great about the closed-end fund space is here at RiverNorth, we can create a very diversified portfolio, and we don't have to get hung up on individual security selection. The individual security risk and, frankly, the sector risk is diversified away when we're creating our portfolios. We are left with asset class risk, but believers in modern portfolio theory, we believe that diversity does help reduce risk over long cycles. Here's a chart on IPO trends over the past few years, going back to 2007. You can see in 2007, that was actually a record year for closed-end funds. 40 new issues came to market. $28 billion were raised in a $700 million average. 2008, you can see it's very cyclical. IPOs come out with market sentiment, and so when the market crash in 2008, only 2 closed-end funds came to market, and a measly $131 million average raise in 2008. But since then, 2009 to 2012, and even 2013, the closed-end fund space has been rebounding from an IPO perspective, and we've had a nice little run. That all dried up in 2013 in the second half post-taper talk, and we'll get into the impact of what that had on discounts. But you can see, really sentiment is a big factor in IPOs of the closed-end fund space. To date, year-to-date in 2014, 4 closed-end funds have come to market. 3 of those 4 have been MLP closed-end funds. MLPs have historically traded at premiums to their net asset value. That recently has not been the case. A lot of the historical premiums in the MLP space have now gone to significant discounts. But yet they're still issuing MLP funds, and we think that might be an area that's getting saturated, although there is one fund in the market this month. And then the 4th closed-end fund that came to market in July, it was a biotech closed-end fund, a healthcare fund, and they raised almost $800 million, which is a very good raise. So I think that's a very positive occurrence for the closed-end fund space, that this is the first equity fund that we've had in a very long time. It was a significant raise, $800 million, so I think that's very positive that we're getting away from the historical fixed income trends that we have from 2009 to 2013, because most of those funds that have been issued were all fixed income funds, as everybody was reaching for yield. Because of the leverage that a lot of closed-end funds implement in their capital structure, there's typically higher yields associated with closed-end funds, and so they were easy to sell at IPO. Here's a quick snapshot of just the closed-end fund space. The average yield as of August 31st, 2014 was 6.3%. This is actually down from last year, almost at 7%. It's interesting to note here that the yields are down, but that's mostly because the net asset value or the underlying assets have appreciated. From August 31st, credit spreads have narrowed. rates have actually come down, and so even though discounts have widened out, that's actually brought yields down still because of the net asset value appreciation. Trading at a discount, 91% of the whole space is trading at a discount. Not a very big difference from last year, but if you went pre-May 2013, approximately 35% of the space was actually trading at a premium, so this number would have been 65% trading at a discount. So quite a shift in just about 18 months due to the taper talk and interest rate fears. And you can see that trend here on this chart. The blue column is the August 31st, 2014, red's 2013, and green is 2012. We wanted to add 2012 because I think it's important to note the big change from 2012, because not really much has changed from last year again, but you can see almost half of all the asset classes in August 2012, they were trading at a premium to their net asset value. I think it's 7 out of the 16 asset classes. And now today, we only have one asset class trading at a premium to their net asset value. But a couple asset classes to point out: high yield, investment grade, municipal bond funds, preferred funds, really all the fixed income asset classes. Those were all the high premiums in 2012, and now they have had significant moves down. Again, that's all related to interest rate fears. Another asset class to point out: senior loan funds. They were trading at a premium, even though they're floating rate securities, so their yield will actually increase if short-term rates do go up. You know, I think a lot of people lost faith in that concept as rates went up. Their yields didn't go up because they were actually on the short-term end of the curve. And so those discounts have now traded to significant discounts as well. And then the multi-sector bond fund, the one asset class still trading at a premium, it's worthy to note that that's being skewed probably by a handful of closed-end funds that are trading at astronomical premiums. For example, there's a PIMCO fund trading at a 50% premium to its net asset value. That's right, people are willing to pay $1.50 for a dollar worth of assets. Even though that doesn't make fundamental sense, it still exists in the closed-end fund space, and just another sign of the real inefficiencies in the space. And the last thing to point out here on this slide, the covered call asset class is the only asset class that has narrowed from its 2012 discount level. And that covered call funds are equity-based strategies, but they do have attractive yields in the closed-end fund area. And so I think a lot of investors, as they lost faith in fixed income and afraid of fixed income, they started shifting to covered call funds. So we've seen some significant moves in discount narrowing in that sector. Here's just a quick overview of the whole closed-end fund space. Current average discount, this is municipal bond closed-end funds, taxable fixed income, and equity closed-end funds. So the whole entire space, the almost 600 funds, just wider than 7%. So again, in line with last year, but a little wider, but a lot wider than the 3-year and 10-year average. So we again attribute this discount widening to the interest rate fears in the marketplace. And this gives you, this chart on the left gives you a perspective of kind of where those discounts are. You know, about 75% or over 75% of the funds are trading at a wider discount than 5%. That's, you know, not much different. It's still more than last year, but if you were to go back to 2012 again, that number would have been significantly lower, probably in the tune about 45%. To the premium side, less than 10% of the whole closed-end fund space is trading at a premium. And again, about 35% of the space was trading at a premium in 2012. Mentioning 2012 because obviously August 2013, not a lot big shift from there. The right side, the chart on the right side, you can see here from 2009 to 2012, we actually had quite a bit of complacency in the market. You know, almost about 30% on average were trading at premiums to their net asset value. So investors were willing to pay more than $1 for $1 worth of assets. And again, that makes no fundamental sense, but because closed-end funds have very attractive yields, the investors were attracted to it, and frankly, you know, about 95% of the whole closed-end fund space is made up of retail investors, and a lot of retail investors are not looking at what's going on from a discount premium perspective, what's going on in the underlying assets. They're simply just looking at the yield. And so the complacency in the marketplace over 2009 to 2012 drove a lot of those funds to premiums. And again, that's all changed in 2013 to 2014. Now there's more funds trading at a discount going all the way back to 2008 and 2007. I always like this chart. This gives you a perspective on the sentiment in the closed-end fund space. You know, in a perfect world, this would be, you know, a nice bell-shaped curve where we log each day's closed-end fund going back to 2003. And you can see here, there's a fat tail to the left. And that fat tail to the left is each day's closed-end fund discount, mostly in 2008 and 2009. Today, we're about a 7% discount, and so what this means, only 279 days have discounts been wider than where they were as of August 31st. So less than 10% of the days have been wider than where we are today. Now, if you go all the way to the right, there's not really the fat tail to the right, and that makes a lot of sense because that's obviously on the premium side of the equation. But it's worthy to point out where it is hitting that 1% in premium levels. That is mostly third and fourth quarter of 2012. So we went from one extreme to another in a very short period of time. In the third and fourth quarter, we were trading at premiums, and then post-May 2013, shifted completely to the other side of the equation, went from greed to fear in about a 9-month period of time. Here we've got a long-term perspective on discounts, and you can see the volatility of the discounts. And so, you know, volatility of discounts is very important to us. It gives us the trading opportunities to go between closed-end funds and ETFs, which we'll get into in the strategy. But because, again, 95% of the space is owned by retail investors, they are driven by fear a lot of times. And so because the discounts driven by supply and demand, as more investors sell over that fear and there's not the same amount of buyers, the discounts are getting pushed out. So you can see various events here, Lehman collapse or the financial crisis, you know, discounts hit 27% on average. That's essentially a 7 standard deviation event. It shouldn't occur, but it did, and that was simply, you know, everybody was forced selling, a lot of fear in the marketplace. That's an environment that's obviously very, very unlikely to happen again. Here at RiverNorth, we actually hope it happens again because, again, that volatility, because you know what the closed-end fund's worth, it gives you the comfort to be able to buy as those discounts are widening out. Again, this is not like Apple's price going down. This is purely the discount widening out from the underlying assets. In scenarios like that, a lot of times you can get what we would call a double discount. The underlying assets are selling off extremely, but also on top of it, the discounts are widening out. And going all the way to the right, you can see the Fed funds taper talk. And we just hit a premium for the whole closed-end fund space slightly in 2012, and now we've trailed off. And here's a closer look of that. This is equity closed-end funds versus fixed income closed-end funds. So, you know, equity-based closed-end funds have really just stayed wide, you know, between the 5 and 7.5% range or 8% range. You know, not a lot of positive sentiment towards equity-based securities. Fixed income, alternatively, was obviously trading at a premium to their net asset value. Hit almost a 3% premium on average, and then with the taper talk in May, June of last year, immediately interest rate fears instilled in the investors and discounts widen out. So in a very short period of time, we went from a 2.5% premium to a 7.5% discount, a discount widening of 10%. So that's pretty extreme, and those are the type of environments that we like to see. Frankly, there was just too much complacency in the marketplace in 2012 and pre-May 2013. One of the biggest questions we get from investors is, you know, obviously there's a lot of sensitivity to interest rates increasing. And this chart, I think, it rhymes a lot with what we're going through right now. This chart's from 2003 to 2006, and it gives you a historical perspective on what occurred in the last interest rate hike. And what I mean by hike is the Fed funds increasing in 2004. So you can see here the green line is the discounts back then for fixed income closed-end funds. The blue line is the 10-year Treasury yield, and the red line is Fed funds. And then the purple straight line is the current discount level. So as the Fed was looking at raising rates, the discounts widened out quite drastically, went from about a 1% premium to an 8% discount, so widening of about 9%. That's very similar to what we just saw with the taper talk, widening out about 10%. And again, this was just all because of the fear of interest rates rising. When rates actually started to rise, what occurred is discounts started to narrow. Now there was a choppy road, which volatility is actually a good positive thing for us to trade around, and again, we'll get into the trading strategy in a little bit. But at the end of the day, discounts ended up at 2%. What's most important, if you look all the way over to the right, the red line crosses the blue line. So Fed funds is actually higher than the 10-year Treasury yield. We call this an inverted yield curve, and this is actually I would call a very poor fundamental picture for closed-end funds. Because closed-end funds implement leverage in their capital structure, they typically borrow short-term, and they invest longer in the yield curve, and they have that carry trade. Well, in an inverted yield curve, that trade doesn't work very well. You could have negative carry in that situation. So I would call this a very poor fundamental picture, but the reality is discounts were still just a measly 2%. So the closed-end fund investment community didn't even get the fundamentals of it, but they were very reactive just to the fear over interest rates. So I think the takeaway from here is, investors a lot of times overreact in the closed-end fund space, which presents opportunities for us to take advantage of. So with that, let's dive into the fund. So the Core Opportunity Fund, that is our flagship fund. It was launched in 2006 and has actually been soft closed since July 2011. So RNCOX is their retail share classes. As Alan mentioned, we did recently launch RNCIX, our institutional share class. It has a minimum of $5 million. We are keeping the retail share class soft close at this time, but hopefully you can see from the opportunity set that we just went through in the closed-end fund space, we think it is a good time to take on more capital. And it's important to us for the capital that we take on to have an investor base that's buying a strategy versus buying a track record. And what I mean by that is typically closed-end fund investors are selling. RiverNorth wants to be buying into that weakness as those discounts are widening out. So it's important that our investor base understands that strategy, and in fact, if discounts are widening, they're more apt to allocate more capital than take away a capital. So we want them running away from the lemons versus running with them. And the strategy itself is a balanced fund. So you can think of it as, at a high level, I hate to use the reference because it's never a 60-40, but at a high level it's a 60-40 fund between equities and fixed income. So this is our most flexible strategy. It's the strategy that gives us the ability to invest in all asset classes of closed-end funds, but you boil it all down, the risk profile, we try to keep very consistent, because if we don't and we move the asset mix around quite a bit and the risk profile of the fund, from an asset allocation perspective, that can destroy the alpha that we're trying to generate in the closed-end fund space. So we maintain an opportunistic posture between closed-end funds and ETFs. A lot of investors don't understand when they're looking at the fund why the fund consists of closed-end funds, ETFs, and cash, and it's not all closed-end funds. It's very important to understand that we have utilized ETFs as a tool for us to lock in alpha or excess return. And so going back to the earlier example, if we own a closed-end fund at a 10% discount, and let's just say that closed-end fund is highly correlated with the S&P 500 and it owns equities, and if that discount narrows to 8%, we want to be able to sell that closed-end fund and not necessarily time the equity market. So we'll buy a similar ETF. Let's just call it the S&P 500 index. And so now we've locked in 2.2% of excess return from that discount going from 10% to 8%. around it. So now if that discount goes back out to 10%, we can sell the ETF and buy that closed-end fund again. We've maintained the same asset class exposure or market exposure, but we've locked in 2.2% of excess return, and we get to do it all over again. And you could see that if that occurred, that type of volatility occurred 5 times in a year, which is unlikely, but it gives you the perspective that more volatility is good for us. If that happened 5 times a year, and you add up that 2.2% times 5, you now have 11% of alpha while owning an asset that's at a 10% discount to its intrinsic value. We think that's a very good risk-adjusted return versus betting on individual companies and sectors. And so that's the basis of the strategy of the RiverNorth Core Opportunity Fund. Maintain a balanced profile, but extract alpha or excess return from trading around discounts and inefficiencies in the closed-end fund space. And believe it or not, our philosophy at RiverNorth is that we believe the markets are relatively efficient, or even are efficient, but closed-end funds, because of the IPO process, who owns them, i.e. mostly retail investors, there's a lot of irrationality in the structure or the investors, and given the structure of a closed-end fund, that provides inefficiencies that we're able to exploit. So how do we implement our closed-end fund trading strategy? We try to bucket our trades 3 different ways, because if you're new to the closed-end fund space, you might look at some closed-end funds and say, wow, you can buy the S&P 500 at a 15% discount to its net asset value. So invest $1, or I should say invest 85 cents, but get $1 worth of assets. You will become extremely frustrated pretty quickly that discount doesn't narrow, because you're expecting to get your $1 back. And so we try to always attach a catalyst and say, why is this discount going to go from 15% to 12% before it goes to 17%? And again, a lot of times you'll see just discounts trading at wide levels and never really move. And so the first bucket is statistical analysis or mean reversion trading. We try to look at closed-end funds on a relative basis, so in the discounts of those closed-end funds. And what I mean by that is if a fund's typically trading at a 5% discount and goes to a 10% discount, that's going to be more relatively attractive to us than a closed-end fund that goes from consistently trades at a 14% discount to a 15% discount. Now, we like, obviously, absolute wide level of discounts, but when we have absolute level wide discounts, we're probably just going to have more closed-end fund exposure in our strategies. But the trading of the closed-end fund space, we like the relative movement of those discounts. The second bucket are corporate actions, and so a lot of closed-end funds have company-specific news or actions that create an inefficiency that we're able to take advantage of. Probably one of the most common inefficiencies out there from a corporate action perspective are tender offers, and this is where a fund has agreed to buy back part of the shares at net asset value or close to net asset value. So for example, if a fund's trading at a 10% discount and they buy back 20% of the shares, that's 2.2% if you just participate of excess return. Now, the reality is, because of those shareholders, again, 95% of the shareholders are retail-oriented investors, you can imagine the proxy material coming into the mail to those investors and it gets thrown in the garbage. So this creates an inefficiency for us. When they don't participate, we get their excess shares. So if 50% of the shareholders end up participating in a tender offer, that 20% tender offer ends up becoming a 40% tender offer to us. So we're able to get more of our shares back at net asset value because of other investors not participating. And literally, I'd call that free money that all they had to do is read their proxy material. But some other corporate actions that are out there are fund mergers, rights offerings, so funds that are issuing new shares, typically at a discount to attract investors in the fund. Shareholder distributions, dividend cuts, dividend increases, funds that are converting to open-end funds, and even liquidations. And also, I would also say IPOs, after they go public, a lot of times there's an inefficiency of just how they trade. Sometimes the IPO investors will overreact and oversell the fund as well. The third bucket is shareholder activism. So this is where RiverNorth doesn't consider ourselves an activist, but rather we look at other institutional investors that are out there that they call it that other 5% that owns the space, and they might increase their share position in a closed-end fund, willing to go to the mat or fight, if you will, the board of a closed-end fund. So each closed-end fund has its own board of directors. That board of directors has a fiduciary responsibility to the closed-end fund investor, not the fund manager. And so if you have a fund trading at a 15% discount, where it can be liquidated tomorrow and everybody would be 17.5% richer if you do the math, you can see why there's a conundrum at the board level. So some shareholders will increase their positions in closed-end funds and go to the mat and potentially have a proxy contest if they need to extract that value in the closed-end fund. So we at RiverNorth trade around the shareholder activism opportunity as well. And then the one other catalyst, if you will, and it's not really a catalyst, but the other benefit of investing in closed-end funds is that if you do own them at a wide discount and they do have a distribution, there is enhanced yield. So I would add that as a kind of a fourth benefit to adding or trading closed-end funds, is that if you own a closed-end fund, again, let's just say it's at a 15% discount to its net asset value, you're going to get 17.5% more yield than you would if you own those underlying assets directly. And that's simply because you own those assets at a 15% discount to its net asset value. So we are getting paid to wait with excess return for a lot of these wide discounts to narrow. The current positioning of the fund, the Core Opportunity Fund, the top two charts is current, and the bottom two charts are August 2013. The investment vehicle allocation, we are 62% closed-end fund exposure, 23% in ETFs, and 15% in cash as of August 31st, 2014. This is not a very big difference from last year, but what these charts don't tell you, because they're just a point in time, is the path of going from 62% to 61%. We actually took the 61% up all the way up to 85% in December 2013. We were in the middle of tax loss selling last year, and also off the heels of interest rate fears and discounts widening out quite a bit. So a lot of investors in the closed-end fund space were sitting on large losses, and there's a fourth quarter phenomenon that usually takes place, which is tax loss selling, and investors are notorious in the closed-end fund space for harvesting those tax losses because there's so many muni closed-end funds. In tax-sensitive investors, I think that's spilled through to all closed-end funds. But this provides a nice technical imbalance that we're able to take advantage of. And so we increased our closed-end fund exposure up to 85%. Since then, we've brought that exposure down to 62%. And the 15% cash and cash equivalents, it should be noted that doesn't mean we're bearish on the space. That's actually pretty common. So we typically have, it's not uncommon for us to have 10 to 20% cash in the portfolio at any point in time. Number one, what this does is offsets the leverage that a lot of the closed-end funds are taking on. So if a closed-end fund has $1, but they borrow 30 cents, we now have $1.30 of exposure. So we're able to keep some cash on our balance sheet, but yet still be fully invested. And then that cash becomes our dry powder, our liquidity source if we needed it. And in this type of structure, we're never forced to sell closed-end funds if we have a redemption. So I think we have an advantage to separate accounts out there. A lot of investors get frustrated by trading the closed-end fund space, and this ends up becoming an advantage to us. And so actually, while we're on topic of trading closed-end funds, RiverNorth is considered that outsourced analysis, portfolio construction, but then most importantly trading, because a lot of investors in the closed-end fund space are frustrated in trading closed-end funds. And the way we trade closed-end funds is we trade off of discounts. And we've created our own proprietary execution management system, currently called AutoTrader, but we are getting away from the name AutoTrader because it's not a black box. It doesn't automatically trade. What it does do is it estimates the current discount on an intraday basis, and our traders are able to put in a target discount level that we're willing to execute on. And to the extent that that discount is hit, then we're executing. So it's not a black box of generating ideas, et cetera. It's purely just an execution management system to trade off of what I would call limit discounts versus limit prices. But from that standpoint, if anybody has a better name than Auto Trader, we're willing to listen. Changing gears on the asset allocation, on the right side, you can see we're quite diverse over various asset classes. Equity. Our equity allocation is 55%. This is slightly down from 57% last year, so not much has changed. Hybrids has come down as well. The reason that exposure has come down is because our fixed income exposure is increased, and with that fixed income exposure, we have some risk-based assets. So assets such as high yield that might be correlated with the equity markets. And so what we try to do is manage the overall beta profile of the core opportunity fund to about 0.55 to 0.65 to the S&P 500, and that's on a look-through basis to each closed-end fund, including the leverage, et cetera. So it's again why we typically have higher cash on our balance sheet. And this gives you a historical perspective on our closed-end fund allocation. You can see here in December 2013, we did ramp it up to about 85% closed-end fund exposure. This is the most closed-end fund exposure we've had since October 2008. And the chart doesn't go back that far, but we view this as, again, a nice technical imbalance. After the complacency that we saw from 2009 to 2012. It was an opportunity to increase our closed-end fund exposure, and as the tax loss selling season was over and we were obviously in a new year, we started to bring that down, harvesting some of the alpha that we've generated in the strategy. Here's a chart that shows us a snapshot of the asset allocation of the fund at the end of the year going back to 2008. And the gray box is our strategic asset allocation. So in 2006, when we launched the fund, we wanted a home base so we can kind of base our asset class moves. What we are never is the strategic asset allocation, but it still gives us a home base of a optimized, risk-adjusted portfolio on the mix of asset classes, gives us the best risk-adjusted return. That said, we're never that strategic asset allocation. But what the takeaway should be from this slide is that we're not trying to market time asset classes. Now, closed-end fund discounts will lead us in certain directions, but ultimately with correlations of asset classes, we're able to counterbalance the risk in the portfolio somewhere else. And overall, the 0.55 to 0.65 beta is pretty consistent throughout various market cycles. Performance for the Core Opportunity Fund has been strong since inception. It's a 4-star fund. It's currently in the 14th percentile for the past 5 years. You can see the fund's up about 8% year to date. That's in line with the 60-40 blend, trailing the S&P 500, which we would expect when the market's up significantly. And then the closed-end fund index, that's our proprietary index that we've created. And we wanted to create an index that's unbiased to various discounts in the closed-end fund space. So this has about a 0.98 correlation to the whole taxable closed-end fund space. So we think it's very representative of the closed-end fund space. What we're not trying to do is beat the closed-end fund index. We expect when asset classes are up or positive that the closed-end fund index should outperform us. And a lot of that has to do with the leverage of the underlying assets. In addition, you have positive sentiment and those discounts are narrowing. So our job with the Core Opportunity Fund is manage the risk-adjusted returns, manage the probability of discounts narrowing before they're widening, and as you'll see in a little bit, volatility of those closed-end fund discounts can get quite exacerbated. The since inception return is 9%. It's almost 300 basis points higher than the 60-40 blend, and obviously higher than the S&P 500. And then the closed-end fund index is the laggard in the group of 5%. A lot of that underperformance was from 2008 because of the volatility of discounts and underlying assets. And so again, risk-adjusted returns is what's paramount to us. And speaking of which, this is a nice slide that illustrates that. Our volatility is approximately 14%, or our standard deviation for the fund is about 14% compared to almost a 19% standard deviation for the whole closed-end fund space. So the purple circle. So a lot less volatility than the closed-end fund space, less than the S&P 500, but yet our return is approximately a third higher. So risk-adjusted returns is what we're shooting for, a high Sharpe ratio, and with that we need various market cycles. The past 3 years, or let's call it 2009 to pre-May 2013, did not help because of the complacency in the closed-end fund space. So now we think that complacency is no longer here, and obviously interest rate fears are here to stay as well, so we like the choppiness that we think we're going to see going forward. Piecing our performance on a year-to-year basis, you can see we never are going to be your best performing fund in your asset mix. We shouldn't be. We're a very diversified, balanced strategy, aiming to hit singles and doubles by generating alpha through the closed-end fund inefficiency. That said, our performance going back to 2007 on a year-to-year basis, 7 out of the 8 years here shown, or periods of time shown, we were in the top 50%. So you would typically think we should be right around the middle. 2011 was an outlier where we lagged. We typically have 25% of our equity exposure and international exposure, which would include EM as well, and you can see the underperformance there. So that's more of an underperformance from our strategic asset allocation rather from closed-end fund selection. In 2009, coming off the heels of the volatility in 2008, you can see our performance was off the charts. We were almost the best performing asset class, with the exception of emerging markets, generating almost 80% return. So you put all those years together on an individual basis, but when you accumulate those singles and doubles, maybe the occasional triple, what this has done since inception of the fund, we've generated the best performance relative to all those asset classes on a cumulative basis, with the exception of gold. And obviously, I wouldn't consider gold as a core holding for many investors. But plus, you're obviously going to have a much wild ride just holding one asset class. So we're quite proud of this accomplishment since the inception of the fund. And I think it shows you the benefits of the diversification and adding alpha from the inefficiencies of the closed-end fund space. And this slide shows us where that alpha has really, how it's come together since 2008, January 2009. The green line is our attribution from closed-end fund discounts. The blue line is the taxable closed-end fund space's discount over that period of time. And I think the takeaway here is that the closed-end fund discounts were all over the map. But yet we've consistently generated alpha. Now there's periods of times that it declined a little bit. Obviously in the first quarter of 2009 there was a decline, and obviously the market was quite drastic with discounts widening out. But that volatility ends up producing future excess returns. So again, to reiterate, we want volatility of discounts. That's our alpha source for future returns because of investors overreacting to the volatility in the marketplace. But keep going back to January 2009 or December 2008, we've been able to generate 22% of cumulative alpha for the Core Opportunity Fund. If you divide that by the 5.5 years, you're about approximately 4% average annual alpha for the Core Opportunity Fund. And I think one of the takeaways here on this slide is if you go all the way to the right, with the taper talk and discounts widening out quite a bit, going from, let's call it, from 2% to about 8% in a very short period of time, we still were able to generate 2% of alpha over that period of time. And a lot of that had to do with the flexibility of the strategy. We had equity-based closed-end fund exposure predominantly in the portfolio. We had very little fixed income closed-end fund exposure, literally licking our chops, waiting for the shoe to drop, and in fixed income closed-end funds coming off the premium levels that they were trading at. And when that happened, we were able to rotate and be able to take advantage of that inefficiency. So with that, those are my prepared remarks. We're going to turn it over to Alan to moderate some Q&A.
All right, thanks, Patrick. We have quite a few questions here in the queue, so I'm just going to take them in the order that they came in. Obviously, you've touched on pieces of a couple of them, but we'll just ask them and get some additional comments in case you've touched on it before. So question number one, and this is dovetails nicely with the very last slide. Can you give some idea of how each of the following factors have contributed to performance? Tactical asset allocation, security selection, and narrowing of spread between market price and NAV.
Yeah, so the attribution of a closed-end fund in our strategy, you can imagine, is quite the task, and we have an analyst dedicated to doing that, and it's excruciating and trying to bifurcate all the pieces to the equation. So the tactical asset allocation and the security selection, I would actually combine those two. And security selection for us, if you just look at the net asset value, we're not investing in closed-end funds for the manager's skill, but rather it just ends up becoming asset class exposure to us, because you start putting a lot of these funds together, the manager's skills diversified away, or lack of skill even. Some get lucky or unlucky. So in the tactical asset allocation, as hopefully you can appreciate, we're not necessarily trying to time asset classes, because we believe that's a riskier bet than timing discounts. So we're trying to just maintain an asset mix that gives us a more consistent risk profile. So what that leaves us with is asset class exposure, or more consistent beta, if you will, and the discount narrowing. And the last chart that I did show, we've been able to generate 22%, or about average annual, about 4% of alpha in the core opportunity fund.
All right, question number two. How do you manage the illiquid nature of the closed-end fund space with regard to new asset addition and liquidation in the mutual fund?
Yeah, that's a great question. The inflows and outflows of the core opportunity fund, I think it's a strategic advantage to have our strategy in a fund structure, because we're never forced to buy closed-end funds, or we're never forced to sell closed-end funds with those inflows and outflows if it was a separately managed account strategy. And so if there's not enough closed-end funds to buy at attractive discount levels, we can simply buy ETFs if we have an inflow, or sell ETFs if we have an outflow, and all the while, we're maintaining our market exposure. So we're able to, take advantage of other strategies that might be out there that are forced to sell and buy because of technical reasons, because of inflows and outflows. And then, to hit upon our execution management system, that's important to us as well from a trading perspective, that we can set the level of discount that we want to buy and sell at, and do it very systematically at the discount we want. We never come in and say, we're going to buy this closed-end fund and push the price up. We say we're going to buy this closed-end fund at X discount. To the extent it gets there, we're executing. To the extent it doesn't, we're not.
Question number three. Can you talk a little bit about 2008, 2009 performance for the core opportunity fund, and in your opinion, do you ultimately need that type of environment in order for the strategy to succeed?
In 2008 and 2009, that was very extreme closed-end fund movements and the discounts. I think you saw it was 20. There was one day that it hit 27% on average. That was literally one day in October. It immediately bounced back. So we don't need that type of volatility for sure, and nor would we expect to have it. That was really a pure forced selling. But what's important, that you have dry powder to be able to continue to buy into further discount weakness. And so that's where management of our overall closed-end fund exposure is very important. Typically, our closed-end fund exposure is 50 to 70% of the fund, and with the rest being cash and ETFs. That gives us enough dry powder to be able to buy into discount widening, because we never know when discounts are going to widen, when the next headline is going to come out and fear is going to be there and discounts go further and further. So we don't need that type of volatility. What we don't want is the period that we had, let's call it, post first quarter 2009 to pre-May 2013, where there was, frankly, just a lot of complacency in the marketplace. And that's predominantly the two-thirds of the space being fixed income closed-end funds, went to premiums to their net asset value. And so complacency is actually, our worst market, and I don't think we're going to see that again as well, just because of the fear over interest rates.
Gotcha. So right behind that, we have a question about equity versus fixed income closed-end funds and the alpha potential for each of those two asset classes.
Yeah, that's actually a great question. Fixed income closed-end funds are our favorite asset class to trade, and the reason being is that the discount volatility is greater. As you can appreciate, in 2008 and 2009, with the equity market selling off quite drastically, closed-end funds, fixed income closed-end funds were highly correlated with what was going on in the equity markets from a market price perspective, even though the underlying assets might have been negatively correlated or slightly correlated. And so what that meant, the difference between the two was discount volatility. So that gives us a much better opportunity to generate alpha. And so that's again why we're quite excited about the environment that we're in now, and we think is here to stay for a while, and if not for a very long time, if this is a secular trend in fixed income.
All right. Next question. We have a question about the credit rating of the portfolio, and I'll take this one. As of 6/30, which was the last publicly released information on credit rating, the fixed income portion of Core Opportunity was 54% below investment grade and 46% investment grade. Any comment to add to that, Patrick?
No, I mean, and that's, if we do dial up our below investment grade exposure or our credit risk, that credit risk tends to be correlated with the equity markets, and so that's where you would see us dial down our equity exposure and beta adjust the portfolio. Again, trying to keep it more in a 0.55 to 0.65 profile, so you as allocators know where to position it in the portfolio and know what to expect from a net asset value performance, and let us handle the alpha extraction and the closed-end fund discounts.
Patrick, someone had a follow-up question. On slide 19, which showed our asset class allocation, each of the asset classes, when added up, totaled 117%. So the question was, is the fund levered?
The fund is not levered. The underlying closed-end funds implement leverage in their capital structure, and that's why you'll typically see a high level of cash in the portfolio, which will counterbalance the closed-end funds leverage. So we take that into consideration in our portfolio construction.
Great. Question about fee. I'm combining a couple questions here about fees. One of our listeners has commented on he or she has seen fees ranging anywhere from in the 130s all the way up to the 220s. So can you talk about why there's differing numbers out there, and what do those mean?
Sure. The expense ratio of the Core Opportunity Fund retail share class is at 1.35%. The expense ratio of the institutional share class is 1.1%, so 25 basis points less. That's what I consider to be the expense ratio of the fund. And then the fees that you're talking about are in the 2% range. That includes the acquired fund fees that we're buying in the closed-end funds. But because closed-end funds are exchange-traded securities and the market price deviates from the net asset value, we at RiverNorth, don't get too hung up on the expense ratio of the underlying funds, because ultimately we're trying to extract the difference between market price and net asset value to add our alpha. The SEC and our prospectus requires us to include those acquired fund fees, and the irony of that is the more closed-end fund exposure we have, presumably the more opportunity we have, the higher our expense ratio we would have on a grossed-up basis. So I would say the higher you see our expense ratio probably is an indication of more opportunity in our space in an ironic way.
Great, thanks. Next question. One of our listeners has a two-part question on a couple of closed-end fund sectors. One is, why are MLP closed-end funds trading at discounts? And then number two, why have muni closed-end fund discounts been increasing lately?
Yeah, so MLP closed-end funds trading at discounts, and I think you can probably throw in munis as well. Both are yield-based securities, and this is really coming off of the heels of the taper talk of last year and the movement. It almost becomes self-fulfilling. First, you had fear. A lot of these funds were trading at premiums, so high market prices relative to their net asset value. The underlying assets, the net asset value, exhibited some volatility. That spooked the investors that were holding these securities, the complacent investors. When they started selling, now you have more volatility, which is the market price coming down below and discounts widening out, which spooks even more investors. So that's the self-fulfilling part of the equation, that the more investors that sell, the more volatility they have, that the more investors you have that are selling as well. It ends up getting to a point of value, which I think we're at now, where a lot of these MLP funds are trading at high single-digit discounts that frankly were trading at premiums at one point. And the same thing with muni closed-end funds. A lot are trading at high single digits, even double-digit discounts that were trading at premiums at one point as well. I think once the fear subsides, and that fear might subside over interest rates when interest rates actually start to increase. So that's the slide that we had earlier that you saw from 2003 to 2006 when rates started to go up. The fear was no longer there. Now investors felt more comfortable buying, value-based assets.
So Patrick, to reiterate that point, next couple of questions are all about, number one, discounts still seem relatively wide. What would cause them to narrow? And then do you care to comment on what a 1 to 1.5% increase in rates might do to closed-end fund discounts since they are levered?
Sure. Yeah. So what will be the catalyst for them to narrow? There's two ways to look at this. There's the security selection. There's also the asset class categorization, and then also the whole closed-end fund space. So, I think what you're not going to see, or I don't think you're going to see, is the whole closed-end fund space go back to where it was trading, and also fixed income funds go back to the premiums that you saw. Because I think interest rate fears are here to stay. What I do think you'll see is choppiness of those discounts. So I think when you start to have some interest rate fears subsiding, you're going to start to see investors say, "Oh, I can, get a 6.5% tax-free yield in muni space, which is, a double-digit tax-equivalent yield. That's pretty attractive. I'm gonna go there," and you're going to start to see those discounts start to narrow until interest rate fears come into the picture again. And so I think we're going to be in this ongoing cycle and choppiness of those discounts. From interest rates going up 1 to 1.5%, number one, you have to say, where is that going to occur on the curve? Is it the short-term rates, or is it the longer end of the curve? And I think if it's on the longer end of the curve, like we saw in 2013, with rates going up over 1% in a very short period of time, in 2013, the fund's performance, the core opportunity fund's performance, was up over 15%. So obviously, interest rates increasing and the discounts widening didn't impact the core opportunity fund's performance that much. We're able to have the flexibility to manage our overall duration risk in the fund, et cetera, and not be exposed. Where I think the bigger impact will be is when you see short-term rates increase 1 to 1.5%, especially if that happened very quickly, because then you're going to squeeze the carry trade that I was talking about before, where you might see the long end of the curve stay flat, but the short end come up, which is going to squeeze the spread for a lot of these closed-end funds that are implementing leverage in their capital structure. So that's something that we look at to manage the overall closed-end fund exposure and our interest rate sensitivity for the whole fund.
Gotcha. All right. We're bumping up on about an hour here, Patrick, so we're going to have a little speed round here on the last couple questions. First question, can you talk about the difference between core opportunity and equity opportunity from a strategy standpoint?
Sure. The core opportunity fund, that's our asset allocation fund. Think of that as more of a balanced fund, equities and fixed income. The equity opportunity fund is purely equity-based closed-end funds and ETFs. So strategy is very similar, but with the equity strategy, for those that have equity allocations to large cap, et cetera, that's going to be very similar to the equity opportunity strategy with a little lower beta than you would get just allocating to a large cap growth fund or a large cap value fund, for example. But we don't allocate to fixed income-based closed-end funds in the equity opportunity fund.
Great. A couple questions about RNCOX and RNCIX from a structural standpoint. Number one, can you define a soft close for RNCOX?
Yeah, RNCOX soft close means that current investors and advisors that are allocated to RNCOX can continue to allocate for their investors. So even if they have new investors come in, they can continue to allocate because of the soft close designations at the advisor level. And then we don't have any plans to hard close this strategy.
Great. A follow-up on that is if I have over $5 million in RNCOX, can I exchange into RNCIX? And I'll answer that. The short answer is yes. It is platform specific into the actual logistics of how that happens. So please let me know if anybody has that situation. But philosophically, yes, with over $5 million in RNCOX assets, we will allow an exchange into RNCIX, all things being equal. A question on RNCIX, Patrick. With your move to an institutional share class, are you anticipating more institutions, pension funds, and the like to enter the closed-end fund space? And then the second part of that is, why have we not seen that happen, broadly speaking, so far?
Yeah, to answer the latter question first, it's to have an institution come in to the closed-end fund space and first of all manage that portfolio themselves would be nearly impossible. I mean, you're going to have to construct the portfolio, monitor the portfolio, and trade the portfolio, and I think that would be very inefficient and frankly probably create some inefficiencies for us to be able to take advantage of. But with the launch of the institutional share class, while it's called an institutional share class, it's really, that's our high dollar minimum fund. But, we will see institutions come into the space. We do have some institutional investors in our products. These are investors that understand the inefficiencies in the closed-end fund space and are viewing our alpha as unique and alternative compared to that they can get out other places. So, I don't think you're going to see a huge amount of true institutional interest in the whole closed-end fund space because at the end of the day, it's a unique animal. There could be more volatility at specific points in time. Our investors tend to understand that versus potentially some bureaucratic institutional investors, investment committees might not understand that in the uniqueness of the closed-end fund space.
Gotcha. All right, with that, we're a little over our 1 hour allotted time, so we're going to call it a day there. I want to thank Patrick for joining us today. We really appreciate your prepared comments, Patrick, as well as answering all the Q&A. I realize we have a large number of unanswered questions, so I will do my best to get those answered in a follow-up email or call once we finish today. Again, if you do want a copy of the slides, please be sure to email or call me, and I will get those to you by the end of the day today. And with that, one more thing we'd like to add is we are updating fund statistics for all of our strategies monthly on the RiverNorthFunds.com website. So even though our printed materials come out quarterly, we do update the statistics monthly on the website, so please go to that if you have questions about portfolio positioning each month. And with that, our time is up, and we very much thank you for yours, and we look forward to seeing everybody on a webcast down the road. Thank you.